Navigating the complexities of sustainable investing is a journey of understanding both its potential and pitfalls. It's a landscape where idealistic environmental, social, and governance objectives often clash with the hard realities of investment outcomes. The gap between aspiration and practical implementation poses a significant challenge. Consider the case of ExxonMobil's proxy campaign, a telling example of the struggle between ethics and profit. This scenario underscores the delicate balancing act required in sustainable investing. Investors often grapple with aligning their moral compass with the pursuit of financial returns, all while steering clear of the perils of greenwashing. Investors are learning that sustainable investing isn't just about the financial bottom line, but also about making a meaningful impact. Despite these hurdles, the transformation towards sustainability in the investment world is not just possible, but increasingly becoming the norm. Learning from both successes and failures, investors are gradually discovering ways to harmonize ethical considerations with profitability, transforming challenges into opportunities for growth and positive change. Mike, I don't know if you want to speak about ExxonMobil or have another example, but how do you evaluate the effectiveness of shareholder activism in driving ethical and sustainable practices in large corporations?
So this is a bit of a heretical view, but it is our view. We did a report last fall, November, called Making ESG Real, a return to values-driven investing. And what we're proposing basically is it's not for everybody, but there are, and it's certainly not for the public pension funds, the fiduciaries, but there are investors, especially those of means, family offices and the like, maybe some foundations, others, who probably would say, we're willing to sacrifice some percent of returns for actually evaluating in a serious way the effect of companies with regard to environmental or social issues. And we call that a values fund. People buy electric cars that may be more expensive. People buy organics. There is a percentage of our universe, again, mostly more young people of means, women, who care enough about these issues. They should have the opportunity to have a genuine ESG fund that really evaluates the social and environmental risks associated, not just to them as investors, but to people on the planet. Right now, we don't have that. And I'm convinced that if some investment agencies want to go to the trouble of doing it, really getting the data, evaluating what's actually happening in the world, I think there's a pool of people that will go for that. And I think it will begin to change the discussion we're having right now. And to answer your question, I think once that kind of a values fund exists, we're going to see a lot of investors better informed, pushing companies, and companies are going to want to be in that list of the best real ESG values funds.
If that existed, the investor would have to do a lot of that due diligence and research on their own versus just using like an ESG or social responsible database where it's some kind of ranking.
Well, look, I think right now the ratings agencies work with the data they have. It's just insufficient. If you had real data, you could have frameworks where somebody's evaluating just as they do now. They just have a heck of a lot more data to work with. There's something called Pearson's Law, which says that which is measured improves, and that which is measured and made public improves exponentially. Right now, we have very poor social data, let's say about global supply chains, the outsourcing of labor. If you had real data about that, somebody could measure that and measure companies against each other. That wouldn't be a problem. The problem is getting the data and really treating that as a priority.
It's an excellent point. I know that I have clients that it varies, right? I have some clients where ESG is not important to them. I have others that say, I just don't want to buy guns. And then I have others who I think would fit into your category. They would say, I'm willing to sacrifice some performance for the values. Carole?
Now, if I can
Yeah,
just add one other thing, I think we can disaggregate the E and the S. Some people really care about climate. There ought to be a fund that really helps them evaluate which companies are doing the best. Others care about diversity in the workplace. There ought to be a fund that looks at that. Others care about the labor, social issues that I'm talking about. There's no reason to have them lumped together when different, as you say, different investors have different interests. We had to accommodate their interests.
And I think, Mike, I can appreciate all the comments that you're making. And I think what you're leading to is a bigger question, which is right now, all investors are relying on stock price as the interpretation of value.
Right.
And, there is the question of the well-being, the overall well-being of the beneficiary. And currently, stock price doesn't take that overall well-being into account. So, there is a challenge of whether stock price is the best measurement for success here, or whether there are other indicators that we should be looking at. And that conversation has been going on, I think, for several decades. I can think back to Beyond GDP, which was a conference that took place in Europe probably back in 2006. But investors are becoming increasingly aware that the value of the portfolio doesn't tell the full story, and they're really willing to start considering these other considerations on their assessment of value.
Yeah. I'd like to jump in and just talk about that Exxon case, because you mentioned it at the outset, Andy. And I think that's a good example of what Carole was just talking about. The share price goes up because fossil fuel is still necessary, but there's a real risk. And I think investors are now recognizing that the risk is not just volatility on the market. The risk is that climate change is going to impact everything we hold. The entire economy is at risk here. We call it systemic risk. So if you hold real estate and sea level rise continues, you're going to lose real estate. If you have insurance in your portfolio and there are critical, catastrophic weather events like we're seeing here in California, atmospheric rivers, this is going to have an impact on that insurance sector that you're holding. So investors are recognizing that you can't just look one company at a time and ask, is it making money for me today? You've got to look at what's the long-term trajectory of the portfolio, and is there a risk from the activities of this company? In the case with Exxon, the biggest institutional investors engaged them for years. I think first went, with California Controller John Chung to the AGM of Exxon in 2007, and I was not the first. There were many, many investors engaging Exxon for a long time. And Exxon was unwilling to move. When other fossil fuel companies began diversifying and becoming energy companies, Exxon has doubled down and said, we're going to draw the last drop out. And so several years ago, investors came together and said, this company isn't well managed. This company is ignoring the facts. And there was a move to remove directors from the board and replace them with directors that the investors believed were going to be better positioned to move this company into the future. And we saw that happen. I think the test is still to come. Will Exxon change with these new directors on the board? But certainly investors are paying very close attention to companies like this that can't stay in the past. They've got to move forward. And investors have a long-term view. They're looking at where their portfolio is going to be, not next month, but over the long haul. They're managing for retirement security, and they intend to be in the market for much longer than any of us are going to be around.
Thank you. Let's bring it home and go to segment 5.